Ladies and gentlemen, please welcome John Creekmur.
Man, oh man, what a great way to start the night. If your heart is not beating, your blood's not flowing, you need to add some Red Bull to your coffee. And if you got a little bit excited when they first came in and you needed to pop your heart medication, feel free to get some water and we'll make sure you are okay. But I want to tell you, first of all, thanks for coming. For those that are watching all around the country on the live stream, good to have you here with us also. And you know, there's some things in life that we see and it's a partial truth. And the thing of it is, if we do not see the entire truth, then we don't see the truth. And if you have our eyes glued to the media today, what we hear is a lot of negativity. And yet things like what you just saw tonight is not presented of things that are good that are happening in all of our communities. You know, that was some students from Dream Center Peoria, and they're right here in our community in Peoria, Illinois. Stacy and I, we are not Midwestern. We are Central Illinois. That doesn't mean downstate south of I-80 Central Illinois. We are three-generation Caterpillar employee Central Illinois. My grandfather was an electrician at Caterpillar. My father worked in technology at Caterpillar. I was born just right across the river at OSF. I was raised in Pekin. I married a beautiful, beautiful woman from Morton, Illinois. We raised our kids outside of Tremont, Illinois. We go to church in East Peoria, Illinois. We work with people from all around the world, but we're Central Illinois. You know, I'm proud of the community I came from, the community where I live, the community where so many of us are from. And there's so many incredible things that are happening. And what I want to start off with tonight is the truth. The whole night is about the truth. In a little while, we'll hear some truth about the economy. We'll hear some truth of things that are happening in the world. And the reason why I want you to know what the truth is because that's how we make important decisions in our life. That's how we make important financial decisions in our life, is by having the truth. I get the privilege of traveling around the country, working with people. I also talk with people from all 50 states, and I hear things that are happening. You know, the last number of years, handful of years, it's kind of been in fashion or in favor to have a negative or speak negatively about the United States of America. And the problem is, there's things in all of our lives we need to work on, without a doubt. But there's so many good things that are happening in communities all around the country. And whenever we think about that, we need to recognize both sides of the equation. I think there's a turning in communities by people deciding to take responsibility and to impact people's lives. Robbie. Hey, Robbie, come up here a second, man. I want to introduce you guys to a friend of ours. His name's Robbie. He's coming up to the stage. And Robbie is from Dream Center Peoria. And Robbie works with students at the Dream Center. And I wanted him to give you just a little bit of a picture of what they're doing here in our local community. And so here's Robbie. You guys, who's Robbie, Chris? And so, Robbie, you brought the guys in tonight to play, right?
Yes, we did.
Yes, we did. Awesome. And so, Robbie, tell us briefly, what do you guys do at Dream Center Peoria? Big picture, and then also as far as in students specifically.
Okay, specifically on the students, but we'll start with the overall. So we deal with community, so we have community outreach. We also have a housing program to where people can stay up to a certain amount of time, and we house homeless people and those that are just trying to transition back into a normal setting. And then we have my great and awesome youth that we serve every day. And so I'm the youth director of DCP students, and we serve youth from ages of 5 years old all the way to 18 years of age. And I've been doing it for the last 12 years. I should get a big hand clap for that, dealing with these young people. Thank you very much. I appreciate it so much. Oh my goodness, the pat on my back. All right. But I love what I do, John. I really do. Seeing, it's a lot of different things that you see. from not only homelessness, but DCFS cases to children, you know, that are literally sexually abused. Like, we can go on and on. I've been there, I've seen it, and it can wear on your heart. But the thing is, I get joy when I see the smiles on their face when they come to us, when they know they're safe, when they know they're protected, they're loved. And we can tell our young men, you know, that we love them. And it doesn't come from a foul place. And they embrace it and accept it. So we do all those different things. We got the athletics. We got what you've seen tonight, our talents program, our creative arts, and we love it. I'm a drummer. And I love drums, right? So I don't get to do all the marching band stuff. I'm too old for that. My knees don't work all the way. So anyway, but I love what we do. I love what we see. And Jeff is our instructor of the drum line, but he couldn't be here. But what it goes, and it shows me tonight, that when you have good leadership and people can follow suit, and you can really let them go and spread their wings and fly, man. And that's what just happened tonight. Their instructor wasn't here, but they still did a great job. So there you go.
Yeah, phenomenal job. Robbie, thank you so much for coming in. Thanks for bringing the fellows, young men in and giving them an opportunity to spread their wings and fly. And really appreciate what you all do as far as making an impact, a safe place, an impact for those in our community that need that. So, man, thank you very much for coming.
We appreciate you. Have a good night.
Thank you, my brother.
All right.
Yep, see you. And we have so many people that over the years have inspired Stacy and I to really find ways to make an impact in our community. And, you know, maybe you're sitting there tonight. I know a lot of you all have found ways to make an impact. And one is Dream Center Peoria. Just so you guys know, inside your booklet tonight, there is actually Dream Center Peoria right here at the top, and there's a QR code there. And if you're looking for a place as far as to donate charitably, they have an unbelievable outreach and impact in our community, both from serving food for those that need food, providing a safe place to stay for those that don't have a safe place to stay, reaching out and helping young men and young women all the way down to nursery age for them to be in a good spot. And so if you're looking for a place to give or even a place to be hands and feet in your community, a tremendous amount of volunteer opportunities, place to connect. If you want, and there's a phone number also, my friend Denise Bailey. If you just give Denise a call, she'll be able to get you structured, hook you up with the proper people as far as on volunteers. You know, there's just a lot of things in the Peoria area that you can apply your hand at. And there's some places we really haven't heard of much. And has anybody heard of a place called the Creekmur Center in Peoria? Some people have. You know, I lived in Pekin my entire life. I had never heard of Creekmur Center. And it's been around in Peoria since 1892. 1892, it's 130 years, but that organization's been serving families, single moms, and children in our community. And so it's a phenomenal place and organization. Dear friend of our firm, Jeff Gress, is executive director there. Jeff's father-in-law, to kind of come full circle, was the first client of Creekmur Wealth Advisors, and had a huge impact on my life personally. And when I see the work that they're doing there, it is kind of astonishing. And, you know, they always have needs financially, but more than financially, they also have need for diapers. They have needs for baby food. They have what's called a crisis nursery. And then they also have clothes, professional clothes. And so when young moms are needing a place, a respite time for their little children, for the time for them to get away, maybe take some stress off, they have no one to watch their children, they can bring their children down to the crisis nursery to care for them. Or if they're heading out for a job interview and they have nobody to watch their kids for the job interview, they have resources in a crisis nursery to take care of that. One of the most incredible things that's kind of become a little bit closer to me, you know, my youngest son works for us. And it's been over, goodness, 23 years since I actually rocked a baby in a rocking chair. Now, we are expecting our first grandchild. Let me phrase that. Our first two-legged grandchild. We do have four-legged grandchildren. But we're expecting our first two-legged grandchild, a little boy, in the month of June. So I'm trying to learn, again, how to rock a baby to sleep. You know, over at Crittenden Crisis Nursery, they actually have a need for people to volunteer to be in the crisis nursery to rock babies. So think about that. You're saying, I'm looking for a place to serve or impact my community. If you can sit in a rocking chair and rock back and forth and hold a baby, tremendous place for you to reach into. You know, or maybe your heart is touched by children that cannot read. Does anybody know how many zip codes there are in the United States? Anybody want to guess how many zip codes? The person that gets the closest to it, we'll actually have you come to the stage, we'll turn the lights down, have a spotlight on you, and you can do the chicken dance and be streamed live around the world. And so I'm sure some of you are. There's actually, here's the number, I found it staggering. From today, they add new zip codes every now and then. There's 41,692 zip codes. 41,692 zip codes. We look at the poorest 100 zip codes. Out of the 41,692, that's the lowest level of per capita income per year, lowest level of household income per year, the highest level of unemployment, and the lowest level of reading comprehension. Of the lowest 100, one of those zip codes is 61605. 61605. Anybody heard of that zip code before? Yep, it's in our backyard, right? Right here in Peoria. A number of families got together and said, hey, if that's ever going to change, we need to see reading levels increase. And so they put together a not-for-profit called Southside Christian Academy right down at 61605. And they have certified teachers, they have a strong administration staff. They started about 6 years ago with kindergarten with the objective to increase reading levels. They'll be at 6th grade next fall. There'll be about 100 students there. Coming into this semester, the vast majority of their students are reading at or above reading level. They have a tremendous need for people that can volunteer. The thing is, there's no tuition to go to school there. Everything is funded by volunteers. And so that takes care of activity time, that takes care of people paying for tuition. It's all funded by donations. But the thing that's really neat, opportunities to serve by going in and being a reading buddy, being a math partner, opportunities maybe to be over the lunch hour for an hour a couple times a week and just help. And so I'm trying to show you in our community, and it doesn't matter if you live in Peoria, if you're in East Peoria, Morton, if you're in Tremont, if you're down in Pekin, if you're over in IVC, if you're in Dunlap, if you're out in Kickapoo, there's so many incredible things happening in all of these communities. And those are the things I'm seeing all of you do. That's the truth. If you're saying, Creek, I would love to have an opportunity to serve firsthand, real fast, short-term commitment. How about I give you one real fast? And if you want to, you can do it with me and Stacy. The first Saturday in the month of May, over in East Peoria, where Stacy and I go to church, it's called Summit Point, up on the hill on 74. The first Saturday in May, they're going to have between 700 and 900 people that head out into all the communities, between 35 and 40 different organizations, including the 3 you saw on the screen today. And the 700 to 900 people go out and work for 3 to 4 hours on the ground at those locations. Sometimes it's a school, sometimes it's for a mom, sometimes it's with Southside Christian Academy, DCP Peoria, different places. If you're saying, hey, I would like to serve, let me know. Let's go and do it together. You see, there is a phenomenal amount of things that are happening or good, and if all you hear is the negative, you're missing out on the entire truth. And if you're looking at the news, you're not getting the entire truth. And man, oh man, do we ever need the truth today? It's one of those things, in order for us to make good decisions in life, it needs to be based upon wisdom, which comes because of knowledge, which is based upon the truth. If you want to make a decision in your portfolios because inflation is ravaging your spending every month, you need to have the truth. If you're concerned about interest rates jumping up, you need to have the truth in order to make good decisions. Facts that are beyond dispute, and we see those decision impacts in every point of our life. Over the last couple of years, we have heard daily from clients and from folks that are interacting and finding us on television, radio, the internet, different channels that we're on. They just come across and see a billboard somewhere. They call in and we hear a couple of questions. Am I going to be okay? I'm getting ready to retire. What do I do to have more conservative investment in my portfolio? And what's interesting is the questions that a number of you put down when you signed up are the same questions we hear every single day. In order to make a decision on any of those things to put you in a better spot, you have to know the facts that you're based upon are the truth. And at Creekmur Wealth Advisors, for 25 years we've been in existence, since 1995, 27 years. You know, we come alongside people to make sure they have the information they need to make wise decisions. And I'm so passionately driven by the fact that every single one of us here tonight, we have important things in our life that we want to accomplish. There are things that are most important to you. We define that as true wealth, all the things in life that money cannot buy, and you're going to hear that phrase a couple times tonight. And the thing of it is, it's unique to you. The person behind you, the person in front of you, their definition of true wealth is different than yours. But it's all about saying what things are most important to you and then using your financial resources to allow you to live it out. Those are the things that bring you joy, that bring you peace, that bring you contentment, things that give you energy. Those are the relationships in your life. It is your faith, your family, and for some people, your food. And it's one of those things that we say we organize our life to execute and live it out. But we can't make those decisions based upon a guess, based upon a theory, based upon what a politician may say or not say. It must be totally the truth. And that's what we're about tonight. There's so many unknowns that are swirling all around us. How high will inflation go? What's the impact of that? You know, my doctor told me a couple of years ago that I need to work on my cholesterol, and he had a little inside scoop and told me I need to stop eating so much bacon. And I thought, I'm not going to stop eating my thick-cut bacon. Every Saturday morning, I like having a pancake. I like having maple syrup that comes from a tree in upstate New York. I love having thick-cut bacon with it. And so I have told Dr. Matt, whenever I see him every year, and I'm seeing him in a month on my physical, I said, hey, just so you know, I did not stop eating thick-cut bacon. But I went down to Beecham's a couple of weeks ago, and I looked at 1 pound of thick-cut bacon, $10.50. So guess what I'm off of right now? Inflation has impacted my life in a very real way, and I'm no longer eating my thick-cut bacon. But what's happening with taxes? What's going to happen? The national debt cannot continue to rise at the pace that it has been rising. There has to be a payment somewhere, a cut in spending, and man, oh man, I sure don't see a cut in spending happening anytime soon. Taxes have to increase. How does that impact me when I'm trying to plan for important things we want to do in the future, for security of our retirement? Other questions come up and they swirl in our mind. With rising interest rates, how is that going to affect the economy? How is it going to affect the stock market? I'm not sure if you even watched the stock market today. It was up 250 points in the morning. All of a sudden then, Chairman Powell from the Federal Reserve begins to speak around noon. It started drifting off around 11 o'clock, and then it closed down, I think, 250 or 400 points. And he said, and what he was alluding to was, interest rates are going to continue to rise 6 to 8 times this year, and not all the time by a 1/4 percentage point increase. That thought of interest rates rising by 50 basis points or more 4 to 6 times this year spooked the stock market. That's a question we're hearing all the time. It's a question a number of you have been asking us at Creekmur Wealth Advisors. It's one of the things that we are sitting there saying, all the things swirling, inflation, taxes, stock market volatility, Russia invading Ukraine, China all of a sudden messing around with Taiwan again. How will this affect my retirement years? Those are things that are very, very real to every single one of us. And whenever I think about that, I think, you know, I need to hear information from a reliable source. I need to know that what I'm hearing is truthful. It is honest. It's based upon facts, not theory. It's not based upon opinion. We are so pleased at Creekmur Wealth to be able to partner with a tremendous firm called First Trust Portfolios. First Trust is based, I believe, up in Wheaton, Illinois. And they have something which I believe is very unique. They have an economic team, an analyzing of economic team that do a phenomenal job in taking the facts that are out there and communicating them in a way that makes sense and is reliable. And tonight, I'm going to go ahead and introduce to you guys Andrew. And Andrew's coming from First Trust Portfolios. And I just want to tell you a couple things. Everything that Andrew talks about tonight is not an opinion. It's based upon fact and numbers. Whenever I think about bringing in different speakers to speak, I want to make sure we have a great relationship with our firm, that we agree philosophically with where they're at, and that we can trust the information that they give us. And I'm going to go ahead and read Andrew's bio and a little bit from him, and then we'll welcome him to the stage tonight. So Andrew's an economist and a member of the First Trust economics team that Bloomberg has ranked as one of the top forecasters of the U.S. economy over the past several years. At First Trust, Andrew is responsible for analyzing economic indicators, writing economic commentaries, and producing articles on the First Trust economics blog. Out of a panel of over 100 economists, investment strategists, and housing market analysts, the First Trust economics team was awarded the Crystal Ball Award by Zillow in partnership with Plus Economics in 2012, 13, and 14, and again most recently in 15, for accurate home price predictions. There have been other awards that have been coming into First Trust portfolios and their economic forecasting team because of the accuracy of which that they analyze information and of which they forecast. Tonight I present to you Andrew Opdyke.
Ladies and gentlemen, please welcome Andrew Opdyke.
Man, that is an introduction. We don't usually get that as economists. We don't get invited to a lot of parties. I've done a couple talks, a couple hundred talks. I spend my time traveling across the United States. This is what I do. I meet with companies, I meet with businesses, I meet with teams, small, medium, large, across the country. Last year I was in 99 different states, took 88 flights. The year before that, a little bit lower in 2020. But what I'm doing on a day-to-day basis is going out to see what is taking place on the ground, East Coast, West Coast, North, South, across the Midwest. And when John came and said, hey, I want to have this conversation. I want to have a conversation about the truth, because when we turn on the TV, when we turn on the radio, when we open up the newspaper, we're getting kind of this microcosm of what is taking place. And this is the biggest thing that I deal with on a day-to-day basis. I can open the Wall Street Journal, I can open the New York Times, the Washington Post, and you're going to get a version of what's going on. And here's the problem I have is that the reporting is often taking a magnifying glass on this broader image and focusing in intensely on one small part. And at times, it causes us to lose perspective. Okay? And the reason they do this is because we find details interesting. And especially when there's details, especially when there's fear, people will stick around. Right? Don't forget the financial media, TV, their job is to sell advertising. And it's a lot easier to sell advertising if they say, come back after this break, and we're going to talk about why we might have another recession. If they said, hey, earnings are doing pretty well and jobs today, we have fewer people on unemployment benefits today than we've had at any point since 1970, you say, wow, things are actually moving in the right direction. You can turn off that TV and you can go outside and enjoy your day. They don't sell as many ads. So they keep calling the recessions, even in good times, bad times. The media's called 152 of the last 3 recessions, okay? There's always negativity, and what I want to do today, what the conversation I want to have is what's going on. What does the data tell us? We're going to go through some charts. It's all going to be data, okay? And this data, it's all publicly available. The government produces it. It comes from the Federal Reserve. It comes from different agencies. I want to dive into what is impacting so many of the things that you're hearing about today. What's going on with inflation? Are we going to a 1970s-style stagflation? Is the economy slowing down? Is the Fed, as they raise rates, are they going to crash the economy? We're going to walk through all that. We're going to talk about the impact on the markets. And where I want to start is with the consumer. Okay, I want to start with retail sales. This is the purchases of goods and services in the U.S. economy. And you look at this chart, there's 2 major things that stick out to me. The first is, let's go back to the financial crisis. That's kind of what a normal recession, quote unquote normal recession, looks like. In the financial crisis, you can see sales were growing at a trend, and then we had the recession and things fell down, and then they restarted growing, but they were growing at roughly the same pace that they were before. Okay, and because of that, because it was kind of this reset period and we got restarted, we got back on trend, it took us about 2 to 3 years for sales to come back and set a new high. Now, let's go to this side. Okay, now let's look at what happened after the COVID shutdown and the recovery. You'll notice that first off, the shutdown was steeper. It was more severe. When we shut down in March and April of 2020, the economic consequences were enormous. That second quarter of 2020 was the single worst quarter of economic performance that we've seen in 100 years. But then we get back to it. And things start to reopen and people start returning to jobs, and what you can see is that we saw a fast recovery. We were actually back. By the end of 2020, we were spending more than we were before it started in 2020. And then in 2021, you can see that another spike in this growth, this health in the consumers. Now, it's slowing down. Okay, it's starting to moderate. How did we get to this point? How is it that this downturn looks so different from this one? What I want to point out is you'll notice 3 jump points. One right from the bottom, and then a second one at the beginning of 2021, and a third one. There's 3 notable periods where you see a spike up in spending. Okay, now, what was going on here? I'm going to let you in on an economic theory. I did my undergrad in economics. I did my grad school at Northwestern in economics. I did the CFA program, which has a focus in economics. Here's the economic theory that got put to the test in 2020 and into 2021. Okay? The theory is, if you give people money, they'll spend it. I know it sounds unbelievable, but it turns out it's true. As the money came in, you can actually see check 1, check 2, check 3. The money came into the system, we immediately saw an impact. Now the checks are behind us. Checks are behind us, and this was a key question going into 2022. If the government's spending $5 trillion, $5 trillion of stimulus spending came into the system, if that's done, and if we've gone through this reopening process and we're not going to get that jump in activity from reopening, can we sustain it in 2022? Well, we're starting to get a lot of the data. We're in earnings season right now for the first quarter, so the banks have been coming out. JP Morgan's been coming out. Bank of America's been coming out. We're getting information from these companies, and they're saying, here's what we're seeing with consumers. And what we continue to hear is consumers are unbelievably strong. And so I was talking with one of these companies. I said, but look, they spend so much money, right? But they can't keep spending at this pace. And Bank of America, we're having the conversation. They said, well, yes, they've spent money. They spent money when the checks came in. They spent part of the PPP. They spent part of that additional unemployment benefits, but they've spent less than half. I was like, wait, what do you mean they've spent less than half? He said, well, here's what we see. This is our clients. We can see their checking balances. We see the money come in, we see the money go out, we know how they're consuming, we know where the revenues are coming from, and they said, look, Andrew, before COVID, the average checking account balance for our customers was about $1,500. He said, do you know where it is right now? I'm like, I don't. $7,400. I'm like, wait, a 4- or 5-fold increase? And so I go and I look at this data, and we can get the data for the other banks, and here's what it looks like. Checkable deposits of households are up $3 trillion. When you take the Bank of America, you take the Wells Fargo, you take the JP Morgan, when you look at the consumer, they have built up massive cash on the sideline. Why? Because of uncertainty. The other thing they did during this environment, they didn't just hold more money to the side, they also paid down debt. One of the key numbers that we watch, the health of the consumer, we say how much of their after-tax income, disposable income, how much of the after-tax income do they have to spend every month on the mortgage, on the car, on the credit cards? How much of that is going back out? When they start to stretch themselves, then we get a little bit more concerned, because if there's a downturn, they don't have that buffer. And what we found is they've paid down debt. Credit card debt's down about $130 billion. They delevered because of this uncertainty. They've paid down debt. And JP Morgan, they keep getting this question. Jamie Dimon, CEO of JP Morgan. Jamie, we've got to see, isn't this going to cause a recession? Aren't consumers stretched? And he said, no. In fact, they're in one of the best situations that we have seen virtually ever. And it's the same thing when we look at the corporate side. And people said, but okay, maybe in the first quarter, but now we're in April. And the prices have gone up and oil shot up. We've seen the Russia conflict. And he said, well, I can't give you all the data, right? Because April's not done yet. But I'll tell you this, through the first half of the month, it's accelerating. It's going even higher. Part of that is that the tax returns are coming in. So he's saying, look, the consumer is quite healthy, and while we're not likely to see a jump at the same magnitude of what we saw in 2021, they have the capacity to spend, and they're doing it. Carnival Cruise Lines comes out 2 weeks ago, said they just had the best week of bookings ever. Best week of cruise bookings ever. And then United was out this morning. They said the forward bookings, people getting on flights, people going to hotels, the airline traffic it's basically back today from where it was in 2019. And the forward bookings, people going on vacation this year, it looks like it's going to hit highs. Okay, people are getting back out, they're consuming. Now, as we've moved through COVID, right, we've kind of gone through a couple different stages. Let's go back for a moment to 2020. Because now we're getting back out and we're going on the flights and we're going to the hotels and we're getting back, we're going to the restaurants, we're doing things more like what we did in 2019. That wasn't the case in 2020. In 2020, if you needed to replace a light fixture or you needed to replace a plumbing fixture, right, and you couldn't go to the hardware store down at the corner because they were closed, where did you go? I went to Amazon. Okay, and so I'm sitting here thinking about this. We moved, my wife and I and my 2 kids, I got a 7-year-old and a 4-year-old. We moved into a new house in March of 2020, right? This was all set up. We had bought the house. We'd gone through the stuff pre-COVID. COVID comes, it hits, the lockdown goes in place. We move the next week, and I need to replace pieces. I go through this, and it hits me. I'm like, wow, this is kind of incredible. I'm doing this. I'm ordering things from my house. They're here the next day. My wife is a 4th grade teacher. All of a sudden, she starts teaching class online. My daughter, at this point, is in kindergarten, and she's doing kindergarten online. And I'm like, wow, wait a sec. What if COVID had happened 20 years ago? You guys remember Y2K? Right? Y2K, when we were worried that the 99 turning to the 00, right? CNN said they had a special, the U.S. missile system might shoot off. Right? We had no idea. Okay? And we were nervous. I was in Naperville. Okay, I was born and raised in Naperville, about 3 hours north here, 2.5. Okay, I was in downtown Naperville on 12/31/99. And I remember the tension in the air as that ball was dropping. And people are looking around and they're like, are the lights gonna go out? Right? Is my VCR gonna start blinking and the tape I picked up at Blockbuster's not gonna work? Okay, there's a tension in the air, and then it hits midnight and nothing happens. Now, let's think about this for a second. It didn't hit me then, but it hits me now. We're in the central time zone, which means that this had already happened an hour before on the East Coast. And I'm thinking, why didn't we know this? Why were we so nervous? And then I remember we didn't have the iPhones back then. And we didn't have the iPads. If you knew somebody who was on the East Coast and they had called you and said, hey, it's 12:01 Eastern time, nothing happened, just enjoy midnight. But that wasn't happening. We are connected in a way today that we weren't back then. There's been incredible progress from an economic standpoint, from an entrepreneurship, from an innovation standpoint. These are the mini miracles that happen day after day, week after week, month after month, that we lose sight of. Because we get so caught up in the downturns, we miss the fact that this chart, as so many others, goes from the bottom left to the upper right. We make progress over time. Now, I was going to Amazon in 2020 to get the light fixtures to replace a toilet piece, okay? And I started thinking, what was Amazon back at Y2K? They were a bookseller, right? And we were wondering if they were going to be able to compete with Barnes and Nobles and Borders, okay? They were just getting into other products. This is 2000. Then a little bit after 2000, we get into 2003, 2004, 2005, and Amazon introduces this thing called Prime. And they say $79, you can get a Prime membership, and with it, you'll get 2-day shipping. Okay, and this made no sense at the beginning. They said, we'll ship you a $7.99 toilet brush for $7.99, and that was the cost of the shipping. I'm like, there's no way you're making money on this. And Amazon said, yeah, we're not right now, but just wait. And so then they keep things going, and they introduce 1-day shipping. Now, the other day, I was getting ready to go on a trip. It was Sunday, it was 7 p.m. at night, And my wife comes in, and she says, hey, the key fob for my car isn't working. I'm like, okay, no problem. We open it up. I'm going to replace the battery. It uses the circular CR2032s. I'm sure you've all seen these before. So I pop open the key fob. I put in the CR2032, close it up. Great, her key fob's working. And then I look, and I'm like, that was our last one. So I go on Amazon to order another one. Go on. It's an 8-pack is about $6.99. And as I'm going to check out, I see an option that I've never seen before. The option on Amazon says, do you want this by the time you wake up? How does Amazon know when I wake up? I guess I buy enough stuff that they've got my pattern down. So I look at the details, and this is a Sunday night at 7 p.m. They say, for $2.99, we will have it at your doorstep by 6 a.m. tomorrow. If this is something that you need to start your day, it will be there. That is incredible. These are the things that we were being told were possibilities back just 20 years ago. We're not talking multiple generations ago. We're talking 20 years ago. And if you were to step back, right, when we think about how much technology has changed, how much our capacity to respond, if COVID had happened in the year 2000, this recovery wouldn't have looked anything like it does today. But because of these underlying trends, because of this data that I think it's underreported, we have all these gears in the economy that are moving us forward, progressing us forward day by day, week by week, month by month, and allowed us to do what we did in 2020. Now we get into 2020, we start getting back outside, we continue to do this year, but we're running into an issue. Right? Demand today, sales today are 25% above where they were pre-COVID. But we're running into issues with the supply chain. Because despite the fact that we're up 25% in terms of purchases, we don't have all the jobs back yet. And this was an area that got immense focus over the last year because the Federal Reserve, the interest rate setting body back in 2020 said, here's what's going to happen. Here's what 2021 is going to look like. They said the jobs are going to come back, the supply chain is going to ease, okay, and inflation is going to be transitory. Inflation's going to come back down, and at the end of 2020, they said that inflation for 2021 should be 1.7%. Now, there's some good news and some bad news. The good news is they did get one of the numbers correct, okay? Bad news is they had it in the wrong spot. It wasn't 1.7%, it was 7.0% inflation in 2021. Now, we did see massive progress on the jobs front. In 2021, we added 6.7 million jobs. That is the single best year of job gains the U.S. economy has ever seen. We've never done that in a calendar year. But did it fix the supply chains? No. Right? We still saw outsized demand and the supply side coming back. Now, you would think that after a year like that, when they said 1.7, it came in at 7, they missed by a little, that they might say, you know what, we need to redo this model. But instead, at the end of last year, they said, okay, inflation's not transitory, but here's what's going to happen in 2022. The jobs are going to come back, the supply chains are going to ease, and inflation's going to come down to 2.7%. Now, they've already had to move it because inflation today is at 8.5%. They've already moved up their expectations. I do believe that what we're at right now, 8.5%, is going to be just about the peak because we saw this pressure from Russia, Ukraine. We were at multi-decade highs for inflation. This added to that pressure, okay? But we are seeing some easing on the margin. And this year, we are seeing, once again, strong employment growth. It looks like this year, we're going to add about 4 million jobs to the U.S. economy, maybe 5. In the first quarter, we added 1.5 million jobs, okay? If we get 4 million, where will that put us? Because in 2 months, March and April of 2020, in 2 months, we lost 22.4 million workers. In 2 months, we nearly tripled the job losses of the financial crisis. And that took place over 2 years. The magnitude of this impact was enormous. Now, we've had this recovery and the job gains running right now more than twice the pace of what we were seeing pre-COVID. We're bringing back jobs faster. But even with a strong performance this year, that would put us just slightly above where we were before COVID started. About 400,000 jobs above where we were before COVID started. If you run the numbers, that's 0.3% more people working if this number is realized at the end of this year versus where we were when we started. We have 25% more demand, and we have 0.3% more people to fill it. Is it going to fix the problem? I think the answer is no. We're still going to have difficulties. And we have to look at where are these jobs coming back. Are they coming back in an area that's going to fix the semiconductors? No. Are they coming back in some of the manufacturing areas? Is it going to fix the shortage we have with autos? No. Is it going to come into the construction industry and it's going to fix the issues that we have on the construction side? No. And companies are still having a very difficult time. A few weeks ago, I was heading down to St. Louis, right? And I'm coming from the west suburbs. That drive between the west suburbs and St. Louis, there's nothing. There is nothing on that drive. Okay, so I'm going down and I happen to come by a station. I'm going to fill up my tank. There's a McDonald's across the street and it's got a sign up that says, "We are paying $15 for an interview." Not $15 if you get hired. Not $15 if you come here and you work here for a month. $50 if you will come in and interview. So of course I stop, right? I didn't get the job, but they told me, they said, look, we're paying $50 just to try to get somebody in the door to try to convince them to come work here, and we can't get applications. We were paying $7.99, $8.99 in some of these starting positions back in 2019. We're at $15 now, and we can't fill it. We've had days where we had to shut down the inside of the McDonald's and only let people go through drive-through because we can't staff it. We have to close early because we can't staff it. There are still shortages. There's still issues that we're going through, okay? And this is going to take time. Where did those workers go? I get this question a lot of time from the restaurants, from the leisure and hospitality when I talk to the hotels. Well, what happened was when they shut down and they were closed in 2020, Amazon came in and said, well, we'll hire them. We'll put them, they'll be drivers. They'll come work in the warehouse. We'll pay them $21 to $27 an hour plus full benefits. They left for other industries. They left for careers that they might not have qualified for before, and now they can get their foot in the door because there was such high demand, but we're still struggling to get these things back. Now, I look at this and say that the supply chain is going to ease things at the margin, but it will not fix the inflation problem. Where is the inflation problem being driven from? It's being driven from that money in the system that created this massive demand for goods and services. Now, bear with me for a minute. I'm going to go through an economics term. Just bear with me for a minute. Okay, the number that I focus on is this number called the M2 money supply. What is the M2 money supply? It's checking accounts, savings accounts, money market funds, currency. The way I would explain it is it's the money that consumers and businesses hold with the banks. It's all the money consumers and businesses hold with banks. Now, this chart is looking at the year-over-year change, and there's two things I want to note on here. One, look at that spike. The magnitude of the increase that we have seen in the money in the hands of consumers and businesses, it's up 42% in the last 18, 20 months. Now, you look at this chart, and you can see clearly, over the last 60 years, we have not done anything like this. Back in the 70s, we expanded money. We put more money into the system. We did it for a longer period of time, but we didn't do it at this magnitude. However, we have done it once before. If we go back in time, if we extend this chart past the 1960s, if we went back to 1942, 1943, we did this. What were we doing in 42, 43? We were financing World War II. We put the money in the system and we incentivized businesses to produce, to manufacture, because we needed tanks and planes and munitions to fight the war for democracy. We saw a very similar jump in the money in the system. Now, we're going to come back to this because this matters. History doesn't repeat itself, but it often rhymes, and we can say, how did we emerge from it that time? What happened afterwards? But the other thing to note is, does this number ever go negative? And you'll see that here, kind of in the 90s, it gets close to zero. It doesn't go negative. It got down to 0.5%. So we add money to the system over time. We don't take it out. We have tried it. In fact, it happened in the 1930s. It was the cause of the Great Depression. When you think about this, if you take the money away from businesses, if you take the money away from households, what happens? They can't spend. They don't spend. They don't go to the bakery. They don't go to the shoe store. Those businesses close. They let go of their workers. Those workers don't have the capacity to spend. You see a significant economic impact when you try to take money out. They're not going to do that. So here's the situation we're in. 42% more money in the system. We can't take it out. What do we do? Now, I like to look at the M2 money supply to get these numbers, but I know I'm the only person probably in the world who gets excited for the day this data gets released. Nobody wants to listen and think about the M2 money supply. Here's how I would think about it. Come with me for a moment and let's go to an imaginary economy. Let's just go to an imaginary economy that only has two things. It's got $10, and it's got 10 apples. This is it. This is our world. $10, 10 apples. Now, think to yourself, I'm going to make you do a little math tonight. With $10 and 10 apples, how much should an apple cost? $1. This is 2019. This is our starting point. This is where it all begins. We have all the money in the system. We have the supply chain. Everything's in line. Now we think about what happens when we move the two sides of this equation. What happens when you add more money? What happens when you add or take away from the supply chain? Let's just think about this rationally. Let's think about this logically. Let's move forward into 2020. Now, the argument was the supply chain decline, that's what led to the inflation. So you know what I'm going to do? I'm not going to do that. I'm going to add the money in. I'm going to have that response, the stimulus money that came into the system. So we're going to go from $10 to $13, but I'm not going to change the apples. They're no more productive, no less. Our economy is producing exactly what it was pre-COVID. There's no change to the supply chain. But let me ask you this. In this scenario, if we have $13 and we have 10 apples, what's going to happen to the price of an apple? It's going to go up. It turns out this is the definition of inflation. More money chasing the same or fewer goods. Okay, the supply chain right now is getting back to where we were, but we have this problem with the money. Now, that was not the only thing that's influenced inflation. Yes, we've also had issues with the supply chain, right? In this scenario with $10, 13 apples, you would expect that additional money flow through inflation, 30% more money, 30% inflation. Now, during COVID, with the shutdown, with the shelter in place, we couldn't produce 10 apples. So what did we have? We had $13 and 5 apples. This is what was going on. This is still what's going on with used cars, right? Used car prices up 40%. The used car prices are not up because we have more money. It's not that people were like, oh my goodness, the check came, I can finally afford to just buy a used car. Well, look at me, I've been buying these new cars, and I had to worry about breaking in the leather, and I had to worry about scraping it up. I'm just gonna pay more and get a car that somebody sat in for 2 years. Right? No, that's not the conversation that's been happening. The reason that the used car prices rose is because we couldn't get the new cars, and so we had more money chasing what was available. When we were in the depths of COVID and that supply chain was constricted, when we couldn't produce, this is kind of happening today with oil, right? There's money in the system, less to purchase. That puts even more pressure on inflation. I'm not going to make you do that math, $13, 5 apples. It would be $2.60 per apple. And this is where the Fed came in and said, yes, but the apples are going to come back. The jobs are going to come back. The supply chain is going to ease. The inflation pressures are going to go down. And I say, true, but if you get apples 5, 6, 7, 8, 9, 10 back, here's what you're doing. You're moving from this situation with $13 and 5 apples to this situation with $13 and 10 apples. You're not going back to our original situation of $10 and 10 apples. We're not going back to our starting position because easing the supply chain does absolutely nothing to remove the money from the system. And they don't want to take it out of the system because it causes a recession. So this is the conundrum that the Fed has today. We have the money in the system. The apples can only grow so fast, and we're having a hard time getting the workers to produce more. So here's what they want to do. They said, look, we're going to raise interest rates. We've done a 25 basis point hike. It's 1/4%. They did that back in March. Now, they meet again here in a few weeks. In May, they're suggesting they're going to raise it by 0.5%. I think they're going to do that again in the month of June. And then starting in July through the remainder of this year, I think they'll go about 25 basis points, 1/4% at a time. Here's the goal. If you make it more expensive to buy a house, make it more expensive to borrow, you make it more expensive to borrow and buy a car, you make it more expensive to borrow and invest in a business or send your kids to school, what happens? You do less of it. And so their goal here is to reduce the pace of money growth, not to take it out of the system, just to have it grow a little slower. And then we let the apples do some of that heavy lifting. If we stop the money supply growth and we bring the production back, we can help with some balance. Now, this is what happened after World War II. We came back from World War II and we were the country left standing, right? Europe got decimated. Russia, China, Japan got heavily impacted by the war. We came back, we had new technologies, we had new processes for manufacturing that we learned to produce those tanks and planes and munitions because when we are forced to, we do incredible things. Incredible things. And we took that learning and we applied it to cars and washing machines and industrial equipment. And so what we did after World War II is we saw a manufacturing boom. Okay, did we get 3 more apples to offset the $3 more? No, we got 2. But that helped ease the inflation burden. Could we see that this time around? Time will tell. I don't know. We have invested massively in technology. We have spent more money on technology, on innovation. We've spent more money on finding ways to work around COVID, to work around the problem in the last 18 to 24 months than we ever have in history. Okay, and you may have heard this before. There's a saying in technology. Technology has never moved as fast as it does today, and it'll never move slower again. We progress forward. Companies figured out ways to adapt to COVID. They figured out ways to let people work remotely. They figured out ways to let people work more productively. They had to do that. Now, as we have emerged and we're getting out past COVID, are the companies saying, okay, all those things you learned about how to be more productive, forget them, we're back in the office? No, they're putting them to work. Okay, we're going to see, and we're seeing massive technologies. How many people in here have heard of Starlink? Okay, we got a few hands. Starlink is going to be Elon Musk's $3 trillion thing. It's a system of satellites that's up in space. Okay, and it circles the Earth, and its goal as it grows is to provide 5G internet access anywhere in the world. Anywhere. You're in the middle of the sea, you get 5G. You're in the middle of the desert, you can get 5G internet access. You're in a war-torn country. Russia has knocked down your communication systems. Somebody tweets at Elon Musk. Says, hey, Elon, is there anything you can do to help Ukraine? Elon tweets back, give me a few minutes. This actually happened. He tweets back and says, give me a few minutes. And what do? The programmers reroute the satellites. They go over Ukraine. It is the only system that has stayed in place active throughout the entire conflict. That's incredible. And we are seeing progress. We are communicating faster. We have more information. We have cheaper, easier access to information than we've ever had before. These things we walk around with in our pockets. We have access to more information than the President of the United States had at Y2K. And we are seeing massive growth around the world. The global literacy rate, right? We're doing the development. We're working with those schools. We're working with the kids now. The global literacy rate up until the 1970s had never, in the adult population, had never exceeded 50%. In the history of the world, up until 1970, we had never seen more than half the population, global adult population, be able to read. Now it's almost 90%. And this is unleashing incredible potential. We've got kids today who they might not even have electricity at home, but they're getting cell phones and they're going to the train station in Bangladesh using the free Wi-Fi and taking school. And they're getting access to classes from world-class universities. This is unleashing potential. We're going to see it happen day by day, week by week, month by month. It doesn't happen in a flash. But this is an unbelievable driving force progressing us forward. Now, inflation, it's not going to wait. The money in the system, the inflation isn't waiting and saying, okay, let's see. Let's see if you get those innovations. People have the money, they want to spend it, they want to do things, so they're chasing what we have right now. How much do we have today? We're 3%. We're 3% above where we were in terms of total production. We have 42% more money in the system, and we have 3% more apples. And this gap between the two, and we're still printing money, it's still growing, and it's going to continue to grow throughout this year. The money is far outpacing the apple production, and inflation pressures remain. And I wish I could tell you that we're going to be back to 2% inflation at the end of this year, or that we're going to be there next year, or that we're going to be there in 2024. But mathematically, that looks near impossible. There are consequences to adding $5 trillion to an economy. It was a short-term impact. It was like giving morphine to a car crash patient. It eased the pain temporarily, but it never fixed the problem. We hid it, okay? And so this is why they're saying, look, we need to think about taxes, because how are we going to pay for this whole thing? And they were going to try to pass legislation. We were going to see higher individual tax rates, corporate tax rates, cap gains rate. That was the plan going into this year. Conflict erupts. That gets put on the back burner. Now, we have midterm elections at the end of this year. And there is a very, very, I would put 95% chance Republicans are going to take the House. I think there's 75% odds the Republicans are going to take the Senate. A little more difficult. They have more seats they have to defend, okay? Which means the tax changes aren't likely to come through. But when we go 5 years, 10 years down the road, what did we do as a nation? We took out our credit card, we spent today, we said, put it on the tab. And we will have to pay it back. Okay, and this is going to have impacts. It's going to slow growth, because when we take money from the private sector and we put it in the public sector to pay our debts that we accumulated before, it's less money to spend today. It's going to be less money to spend in 5 years. And what that does is it's moving our growth rate back towards what we had after the pandemic. This year, I think we're going to grow 2.5% to 3%, faster than where we were growing pre-COVID. But we're moving back to a pace of 2% growth. We're moving back to moderate trend growth, moving forward, but with 2% production per year, trying to fill that gap on the apples, it just isn't possible. So this is the world we're in. I think inflation has peaked. I think it's going to be 4, 5, 6, 7% here for the next few years. The Fed's going to act, but they can't stop it right now. But we are progressing. We are adding jobs. We are investing in businesses. We're opening new businesses. The world is recovering. The economy is moving forward. What about the markets? I stopped here one time in a presentation, and somebody said, wait a second, the economy's up 3%. How is the market up 25%? Is that why we're seeing this? Is that why it's coming back down? Is it in a bubble? And I said, well, hold on. We don't invest in GDP. Right? We don't invest in GDP. That's the whole economy. It's got parts that grow quickly, slowly, no growth, negative growth. In order to think about the markets and understand what's going on there, we have to look at what drives them. And the two most important factors driving the markets over time are interest rates and earnings. How much does it cost to invest in people, products, and projects? And what's the return? Now, this inflation is impacting that. The 10-year Treasury rate, the orange line on this screen, the 10-year Treasury rate was 0.5%, bottomed out at 0.5% in 2020. Now it's close to 3%. Why? Because the Fed is moving higher. Why? Because inflation is hitting multi-decade highs. And here's the thing, it's not just a US problem. This is a problem in Canada, in Mexico. This is a problem in the United Kingdom. This is a problem in the EU. They're all facing multi-decade high inflation, and they all need to lift interest rates. It's pushing this cost of borrowing higher. And that will slow investment. That will slow the growth in the money supply. But if we're at 3%, if we're at 3%, is this historically tight? Is Apple going to say, hey, you know what, hold on, we're not going to produce another iPhone because the 10-year Treasury is at 3%? Is Amazon going to say, you know what, we were about to put a new facility down the street from your house because they just keep getting closer, but we're not going to do it because we're at 3%? No. Look back at history. Back before 2010, in the early 2000s, in the 90s, the 80s, the 70s, they were never able to invest at rates this low. Companies said, look, yes, we're at 3%. Yes, it's more expensive to borrow this year than it was last year and a year and a half ago, but demand is here. Supply is here, and we can get a lot more than 3% return from that investment. So the economy is going to continue to invest. Now, if they borrow that money, the question is, can they put it to use effectively? Okay? And this is my last slide, but I think the most important, particularly from a market standpoint. This is the most important slide to understand what's going on in the markets. Let's go back to the financial crisis. We saw this with retail sales, right? It went, and then it stopped, and we had this longer period. Back after the financial crisis, it took us 1, 2, 3, 4, 5 years for earnings to come back and set a new high. Then we had the recovery, and you can see the impact from the tax cuts, okay? And then we had COVID, and it brought us back to where we were before the tax cuts. Where are we today? This is a key question. Now, can I ask anybody, if you're watching this online, if you're watching the, think to yourself before I show you the numbers, if you're here today, before I'd shown you this chart, how many people can say, oh, I knew where earnings were back in 2019? Anybody? How many people know where earnings were last year? This number just came out about 2 weeks ago, underreported. We constantly hear about the negativity. We constantly hear about the fear. We constantly see our emotions pushed, pulled, driven. But we don't get given the math. We don't get given the data that really drives us forward. Where were earnings last year? Well, they ended the year about $200 per share. They were at about $155 back in 2019. Earnings are up 25, 30%. Why is the market higher? Because earnings are higher. And this year, earnings are continuing to move higher. We're here in the first quarter. So far, the companies that reported, about 75% are beating. Analysts are surprised because the numbers are coming in stronger than anticipated. We're moving forward. But as the pace of growth slows, as conflict shows up, whether that's Russia-Ukraine, whether that's China-Taiwan, whether that's COVID, whether that's, who knows what the next thing will be. There's going to be volatility. It's part of the price we pay to make money in the markets over time. But what we're going to keep doing is going back to this data. When we have the conversations with John, the whole team, what we do is we go back to the data. Because the data, it's a North Star. The data gives us guidance when we turn on the TV and fear is driving everything. Fear is a terrible guide to investments. It's a horrible guide to investments. And I can't time the market. I know you can't time the market either. How do I know that? Because if you could, you wouldn't be here right now. You'd be sitting on a beach in the Bahamas having a Mai Tai, right? Because if you can time the market, you don't need anybody. But the Market Timing Hall of Fame is empty. So what do? We have a process. Because we can't predict tomorrow, we can't predict next week, we can't predict next month, but we can go back to the data, and the data guides us over time. I think the markets are going to trend higher this year. I think that we're going to see some improvement. The 10-year Treasury, we were looking for 2 to 2.5, we're above it. Now it's probably going to close closer to 3. The Fed has gotten more aggressive. Inflation 4, 5, 6%, real economic activity, real growth, real investment, real job creation. It looks like it's growing 2.5 to 3% this year, which is healthy. We're continuing to grow. We're continuing to progress. Sometimes the best possible thing you can do is turn off the TV. Turn off the radio. Close the newspaper. Take a breath. Take a step back, enjoy the day today, enjoy those mini miracles that are surrounding us, and we lose that focus when we're so caught up in the emotion. That's what we're going to strive to do every day, is to dive into these numbers, to get the data, to work with John, to work with the whole team. I love that we got to have this conversation tonight. We get to do it on an ongoing basis. Thank you, John, and thank you, all of you, for giving me the chance to be here with you tonight. With that, want to jump into some Q&A?
Once again, John Creekmur.
I wonder, could I have that announcement every morning when I walk in the office? Here you go, Andy.
Walk downstairs to breakfast?
It'd be great, John. Great.
Thank you.
It kind of makes me laugh. Hey, Jason, could you go back a slide to the Outlook real fast? A couple things I wanted to real quickly highlight. We have a number of clients, I'm not sure if anyone here in the room, that gets this report here on the right. I'm not sure how often that comes out. Is it?
Every Monday.
Every Monday. If you want to get that, and it's just fact-driven information with some commentary on it. Andrew and their team put it out every week. It's a phenomenal resource. If you guys want that, let us know at the office, and we'll make sure to give you directions how to get signed up. During COVID, you guys put out a tracker every week.
Every week, yep.
And this had phenomenal facts on there to give you information so you know where things are. We're going to go to Q&A real fast here, and a couple things on that. A lot of you had sit-in questions. Those that were watching online had sit-in questions. A lot of you had sit-in questions. I brought a number of those were very similar, and so I kind of summarized some of those. If you have more questions, if you're online watching, if you're here in the room watching, you can actually text questions in. They come right to my phone, and just text them to our main office number, which I know you all have it memorized, but in case you don't, it's on the very back of your folder, 309-925-2043. Those questions will come in here. And so we summarize those. There was one question which we're not going to answer tonight, which was, how did a goofy guy like John marry such a beautiful girl like Stacy? And so I'm not going to say who it was, not because I care about not embarrassing them, because I'm afraid I'll egg them on a little bit. And so we're not going to answer that question, but we have a number we're going to go through. And
okay.
And I'm going to start with the first three, which is a summary of the questions submitted ahead of time. Now, if we do not get time, because I'm respectful of everyone's time, if we don't get time to get to your question, just so you know, we have those recorded. By texting them in, we know who asked the questions. And so we'll make sure to get you answers back out to you very quickly here in the next couple of days. And so we'll go through all that. So feel free to text in questions as we're going. If you have other ones for tonight, we'll get to those very quickly here. So the first question that we have is this. It's kind of a summary from about 4 questions off of the ones that were submitted. And Andrew, I'll ask the question and hand it over to you. So
Okay.
the stock market, and we've had nuggets tonight that may have part of the answer here. So the stock market's been really volatile lately. Which way is this going to go? I'm really concerned. What should I do? So big picture question.
Big picture question. So again, I think the market's going to trend higher. Does that mean it's going to happen today, tomorrow, next week? No. Right? The market moves in waves. And let's take the NASDAQ, for example, right? NASDAQ is the tech index. It's been hit particularly hard this year. The NASDAQ came into existence in February of 1971. So this year it celebrated its 51st birthday. In 51 years, how many times has it seen a correction of 10% or more?
No idea.
The answer is 66.
Huh.
66 corrections of 10% or more in 51 years. This is something we see pullbacks, again, because we're emotional, because we're loss averse, because we're fearful. Over that time frame, it started in February of 1971 at an index value of 100. Today it's at 13,500. Through that volatility, it's up 135-fold. So when I sit here and think, can I time the market? Can I try to avoid all that volatility? I can't do that. I've never met somebody who can. So my biggest piece of advice, whether you're investing for the next year or 5 years, 10 years, 20 years, 50 years, is if you can't time the market, your biggest reward's likely to come from time in the market. Having a plan, having a strategy, so when the uncertainty comes, you know what type of data you're going back to. You know why you hold the investments that you do, because so many times staying the course, holding on, and riding things out is the absolute best thing you could do. That would be my best advice today.
I wasn't aware of the number of times. The one thing, guys, whenever you're going through, you see some questions on the very bottom of your pages, and that first one deals with that. And so just so you know, there's a QR code. There's also a website, Financial Truth Media. If you go to either one of those as an example, there's tools, there's research papers that we have written with information from First Trust and other sources that our advisors and financial planners put together. Phenomenal resource. And so if you go on there, and some of you are going through life stage changes or you're getting ready to, it's really important to know what the risk in your portfolio. If we're going through one of those seasons, you're changing life stage, you're changing time horizons, you need to know how much risk. If the market does go down, how much will you lose? There's a great resource on there called Riskalyze, an ability to analyze, put in your symbols of your portfolio, help you analyze how much you can make and lose in different periods of time. So good resource to have on that. Number two, interest rates going up, and it seems like really fast. I hear a lot about something called an inverted yield curve. What is that? And does that mean that we are for sure going into a recession?
Okay, great question. So an inverted yield, we're going to get a little technical here. So the yield curve, basically you can borrow for different amounts of time. You can borrow money for a month. You can borrow money for 3 months, 6 months, 12 months, a year, 2 years, 5. So what an inverted yield curve is saying is it costs more to borrow today in the short term, let's say for the next year. It's more expensive to borrow for the next year than it is for the next 30 years. Interest rates are higher. The amount you have to pay in interest is higher for the short term than it is for the long term. Now, why is that? Why would that be a sign that there's issues in the economy? Well, banks can't sustain that because they borrow money short, they lend long. So if it costs them more to borrow than to lend, they're not going to do the lending. And this historically was the concern. The inverted yield curve meant that the economy was in a position that wasn't going to be able to sustain investment. Usually the reason it was happening is because the Federal Reserve has a lot of control over rates here in the very short term, because they are the base case. And if nothing else, the companies, the banks can borrow from the Fed. The banks can borrow from the Fed. That is the lowest rate you should be able to borrow at. Okay, but they can't control the rates over the next 20, 30 years because they only lend very short term. So when you see this inversion, historically it signaled a recession because historically it meant that the Fed had raised rates so much that it was stopping growth in the economy. I'm not so sure it's the same signal today, okay? In part because we saw that chart. How much money do households have right now? We saw that chart on the M2 money supply and how much money the businesses have right now. This question actually came up directly to Jamie Dimon in their last meeting, and he said, look, right, they will borrow from us because they can put it to work and get more money, but they don't really need to borrow from us right now because they are so flush with cash. We'll watch it. It spooks the market. Historically, a recession doesn't start until 18 months later. So you have some time to think, to look to plan. It did invert back in 2018. Now, did we go into a recession because of an inverted yield curve? Was that inversion telling us COVID was coming? Somehow the bond market knew it but didn't tell anybody else? I don't think so. I think historically it had reason, that it made a lot of sense to look at it back in the 70s and the 80s, but the way that the Fed manages policy changed substantially after the financial crisis. I don't think it's the same signal today.
Very good. That's a question we hear a lot of. We actually see a lot of people talking about the inverted yield curve on media whenever it happens. They need a talking point, so they bring it up. It brings a lot of questions. And again, if you were sitting there saying, okay, let's say a recession does happen, you want some more information, we do have an article that we wrote called What Should You Do with Your Investments During a Recession Volatility. And so again, that QR code on there, the True Wealth Media, is a great place to get those resources. Question number 3. I am really concerned about taxes going up in the future. How will higher taxes affect the economy?
Yeah, it's a great question. So the good news is, if you're worried about tax rates moving higher, I don't think it's going to happen this year. I don't think it's going to get passed through the legislation. And if it doesn't happen this year, I don't think it's happening at least the next 2 years. Because if there's a split, if the Republicans have the House or the Senate or both, the chances of them passing through significantly higher tax rates is virtually zero. But it's going to have to come at some point. You mentioned this at the very beginning. Look, the amount of money that we take in tax revenues has seen its ebbs and its flows over time. One thing that's remained incredibly consistent is that we constantly spend more than we take in. And that's not a Democratic thing, that's not a Republican thing, it's a Washington thing. And it's easier to get elected if you say, look, you're not getting what you deserve. You vote me into office, and we're going to make sure that that spending goes towards you. And so we spend, we increase how much we're spending, and there is going to be a day that it comes due. Now, here's the good news. Because interest rates have been declining since the 1980s, our cost of servicing the debt, how much of every dollar of U.S. production goes to paying our debtors? Those who hold Treasury bonds, the debt of the United States, right now is at one of the lowest levels that we've seen in about 60 years. We pay 1.6 cents of every dollar of production towards servicing our debt. In the 80s and the 90s, that was about 3.1%. We're heading back there. Now, we still grew healthy. We still saw strong growth in the 80s and the 90s, but I strongly believe from an economics perspective, as we start shifting more and more of that money, whether it comes through the taxes or whether we issue more debt to pay that, it's going to have a cost with it, and it slows economic growth over time. That's something we are certainly, I wish I could tell you too, somebody in Washington is ready to tighten that belt buckle,
right?
And somebody's willing to plant that flag and say, look, we got to fix this now, because the next generation's getting that bill that we've run up the charges, but by the time that bill comes due, the people in Washington are going to be gone. So we're not moving in the right direction now, but it's not going to crash the economy in the next 1, 3, 5 years.
Okay, so interesting perspective, right? And so there's a lot of debate on that, seeing where it goes. The election this fall will play into that, so need to be aware of what's happening in the election, not to tell you who you should vote for, just be aware that there is things that happen when there's a change in the House and the Senate. And so at some point, though, we are going to see taxes go higher. It's a natural thing that probably is going to happen, so it kind of plays into that. So with that in mind, we do have the booklet on the website that has 5 tax things to consider if you haven't already, as far as to consider ways to decrease taxes in the future. And I'm going to check real fast, okay, on time. And again, a reminder, if you want to text a question in, we're running low on time, but go ahead and put it in there. There were a number of questions that came in ahead of time that were very specific as far as on a specific investment strategy.
Sure.
And so on those, we're going to, because everyone is different and our backgrounds and goal objectives are different, we're going to hold off asking that question to Andrew. It's very specific, but we'll work together to get you an answer on those questions to make sure it's unique to you. And so if you have more of those questions, feel free to send them over to us. I did have one question that I think is interesting in your perspective on.
Yeah.
And so it does deal with money. It deals with money supply, but in a different form. So view on cryptocurrency, how it affects the economy.
So here's my problem. So I'm an economist. I've spent my time in finance. I spend a lot of time looking at the Fed, looking at the Treasury, looking at the IRS, looking at Congress. Here's the issue that I personally have with the outlook on crypto, is that you can't use it to pay your debt. And until you can use it to pay your debt, it's not going to replace the dollar. Now, that doesn't mean that Bitcoin's not going to rise this week or this month. It doesn't mean it's not going to rise this year. But when I look at it over the long term, I'm like, what is the value that it's serving? Now, the underlying technology, blockchain, that is a technology I think is absolutely going to get used in the economy. It helps track assets. It helps verify the path that certain things take over time. I think a lot of companies are going to use this. Hopefully, we start using that in voting so that we can check. Chicago, we vote early, we vote often, right? It'll help some of those issues. But the blockchain technology I think is going to be something we see more use in the future, but it's separated from Bitcoin. On the Bitcoin side, we do get some people who say, but I love it. And we're going to push it. We're going to force this thing forward. We are going to make companies take it, right? If enough of us get on this bandwagon, we're going to make cryptocurrencies the new dollar. But the problem is, try telling that to the IRS. When they say, hey, your taxes are due, and you say, yep, I'm sending you Bitcoin. And they say, no, you're not. And you say, no, I am. That's the only thing I'm willing to pay. And they say, is that your final answer? Because if that's your final answer, there's a jail cell right over here, and please feel free to go ahead and make your way. Unless somebody's going to go in and convince Washington to give up power, because you'd have to. If we were on Bitcoin, we couldn't have done the stimulus payments. You would take that power out of the hands of Congress. You'd take power away from the Fed. You'd take power away from the IRS. Now, do I think it would be a beneficial thing if we couldn't just print at will? Yes. But nobody goes into Washington and convinces them to give up that power. So I think it's a very difficult path they have forward.
Yeah. It's a very realistic economic path, and it's interesting you talk about blockchain and the technology that drives the different type of cryptocurrencies. That's something that really, those questions we get more and more. And inside a lot of portfolios, we actually have already invested different components of the entire blockchain hierarchy. However, there's ways to take advantage of that, and so that's a great conversation to have with your advisor, either on a quick telephone call or actually face-to-face, so great ones. And I'm going to check real fast, and so no additional questions have come in we want to cover, and so, but if you have anything, feel free to text those over, and I love finishing my interviews or question time with different people that I love hearing from with 3 questions. Okay. And if you've never heard me ask these 3 questions, they're short questions, short answers, 30 seconds or so, but they apply to the things we talked about tonight and things that are near and dear to me. And so the first one is an either-or question.
Okay.
And it's just Andrew. So what do you think? And so, bigger fan of the evil empire Chicago Cubs or of the most beloved team in the history of baseball, the Cardinals? Or is there a different favorite team in any sport?
Yeah, so here's the thing. I grew up, right? My whole entire extended family is from Philadelphia. My dad was a diehard Phillies fan, diehard Eagles fan. Somehow we moved to Wisconsin. My dad went to the University of Wisconsin for grad school. My mom's a diehard Packers fan. That was a fight, and I was like, I'm staying out of this thing. So, growing up, number one, I grew up in the Jordan era. Bulls are number one.
Bulls, yep.
And then I started watching European soccer.
No way.
Back 25 years ago, Liverpool football team, the Reds are I never miss a game.
They're your team.
So I've watched more Liverpool games. I have probably watched 5 MLB games in the last 3 years.
Yeah.
So I don't have a favorite
the Reds.
there. But
interesting. Hey, good year. You're second place on the EPL on the table, right?
Soon to be first. We're actually first right now.
Okay. Oh, okay.
We got a game in hand.
Awesome. Okay. Second question. Who is one person that is alive today or was alive in the past, so they're deceased, that you would like to sit down and have a 10-minute conversation with, and why?
Man. Well, one, religious.
Yep.
Okay, I grew up in a Christian house. I mean, if you could go back and talk with Jesus, that would be unbelievable. If I had to step to another person, I'd love to go talk with George Washington. I'd like to ask those questions. When we were founding this nation,
right?
And we're thinking about what powers should someone hold. Because we're coming away from England where they had a king and they said, we can't have absolute power. How does the conversation look? We have I think is the greatest nation on earth. I think the U.S. is the greatest nation in the world. Our private property rights, our rule of law, our democratic system, I think is second to none in the world. They did a lot of things right. And I would love to hear what that conversation looked like.
Yeah, an interesting conversation. Number 3. With Creekmur Wealth Advisors, we talk about true wealth. All the things in life that money cannot buy.
Yeah.
How would you define that?
Man, as an economist, we do a lot of stuff on cost-benefit analysis. That's so much of what we learned in school. And one of the things that made me think about is money, wealth is a tool, right? You can use that to create time. You can have somebody mow the lawn that gives you time to spend time with family. It's, at the end of the day, it's a tool that we can use that allows us to do the things we really want. And as a dad, with a 4-year-old and 7-year-old, when I had kids, it changed my life. Yeah. And it changed my outlook. You know, before that, I'm thinking, you know what, this is what I want to do with my career, and I want to make this money. And then you're like, I want to raise them right. And I want to leave an impact on them so that when I'm not here, that they can leave an impact. Yeah. And I work, a couple years ago, me and some friends opened up a nonprofit. We actually do some work about 40 miles from here. It's a nonprofit that helps kids facing life-threatening illnesses and their families. And it's, how do we give back? How do we have a lasting impact? How do we make things better than how we got there? Yeah. That, to me, is that ultimate wealth.
Cool. Great answer, man.
Yeah. Great
answer. Thanks, Andrew. Andrew Opdyke.
Thank you.
Well, you know, I hope tonight you walked away with a nugget or a truth, something impactful to you, something that challenged your thought, something maybe that you said, hey, let's get involved in some way in helping to actually live out and execute at a higher level our personal definition of true wealth. And I'm so glad to partner with you and be able to speak with you tonight and be able to introduce you to a friend of ours, Andrew, an incredible firm, First Trust Portfolios. You know, whenever we walk through life, it's helpful to have a friend that you can trust and talk with. That's who we are at Creekmur Wealth Advisors. We're here as your friend, as your financial professional, to help make sure you have information to make wise decisions to live out what's most important to you. If you ever want to get together, feel free to either call the office, request as far as on a pop-up, as far as on the website, just request a 15-minute telephone call whenever we want to walk through things and try to get to good decisions. Guys, I appreciate you. Thank you. Thank you for coming, and talk to you later.